Your mortgage may depend on a government backstop that is not legally a government guarantee. Behind it sit Fannie Mae and Freddie Mac. Together, they stand behind roughly $7.8 trillion of American mortgages. That credibility helps investors accept mortgage bonds at lower required yields. If confidence weakens, those bonds can reprice. New home loans can become more expensive. The structure already required federal intervention once. Both companies entered conservatorship in September 2008. They remain there today. Treasury still has roughly $254 billion of contractual funding capacity available. That is substantial support, but it is not a $7.8 trillion taxpayer guarantee. Several private loss layers now stand ahead of Treasury. So who absorbs the next systemic loss? The answer begins inside one ordinary mortgage note. Start with a 30-year mortgage signed at a local lender. The lender may keep servicing the loan, but it does not need to keep the credit risk. Instead, it can sell an eligible mortgage to Fannie Mae or Freddie Mac. That sale replenishes the lender's cash. The lender can then make another home loan. One mortgage note has become fresh lending capacity. Fannie and Freddie operate mainly in the secondary mortgage market. That simply means they buy mortgages after lenders originate them. They assemble large pools of similar loans. Those pools become mortgage-backed securities, or MBS. Investors buy claims on the homeowner's monthly principal and interest payments. The original mortgage has now become a bond. The crucial layer is the guarantee attached to that bond. Fannie and Freddie promise investors timely principal and interest even when borrowers default. They charge lenders guarantee fees for taking that credit risk. Those fees ultimately become part of the economics of the borrower's mortgage. The guarantee makes a pool of household debts easier for global investors to own. Without that guarantee, every investor would need to price thousands of borrowers separately. With it, much of the borrower default risk is concentrated at Fannie or Freddie. That standardization creates a large, liquid market for American mortgage bonds. Pension funds, banks, asset managers, and foreign investors can buy them at enormous scale. That demand helps recycle global savings back into American home loans. This structure supports a feature Americans often take for granted. A borrower can lock a fixed interest rate for 30 years. The borrower can also refinance if rates fall. That combination shifts substantial interest rate and prepayment risk away from the household. Investors accept that complexity partly because the securities are standardized and guaranteed. The backstop therefore supports not just credit availability, but the architecture of the loan itself. The guarantee is not free. Fannie and Freddie charge ongoing fees and, for some loans, upfront risk-based fees. A basis point means 1/100th of 1 percentage point. Lenders commonly pass those costs into the mortgage rate or closing economics. So a federal housing finance structure that feels remote can appear inside a monthly payment. Fannie and Freddie cannot buy every mortgage. For most one-unit homes in 2026, the baseline conforming loan limit is $832,750. Loans above the applicable limit are generally called jumbo mortgages. Eligibility also depends on underwriting rules covering income, property, credit, and loan structure. That boundary helps determine which mortgages enter the highly standardized agency market. Congress created these companies to keep mortgage credit flowing across regions and market cycles. Their purpose is not simply to maximize loan volume. They are also expected to support liquidity, stability, and housing affordability. That public mission explains why their pricing can include cross-subsidies. Some borrowers receive fee advantages, while other loans pay more. The design deliberately mixes market pricing with housing policy. For decades, however, Fannie and Freddie were shareholder-owned companies with public privileges. Investors widely assumed Washington would not let them fail. That expectation lowered funding costs while shareholders still captured profits. The structure created a difficult incentive. Private owners could benefit from leverage, while taxpayers remained exposed to extreme losses. The contradiction became impossible to ignore during the housing crash. In September 2008, collapsing housing prices and mortgage losses overwhelmed confidence. The Federal Housing Finance Agency placed both companies into conservatorship. Conservatorship transferred operating control to the federal regulator. Treasury then signed agreements designed to keep each company solvent. The mortgage note had reached its ultimate emergency layer. Federal capital stood behind institutions that investors considered essential to housing finance. Fannie Mae eventually drew $119.8 billion from Treasury. Freddie Mac drew $71.6 billion. Together, the cash support totaled $191.4 billion. By the end of 2019, the companies had also paid Treasury about $301 billion in dividends. Those dividends did not legally reduce the outstanding senior preferred stock dollar for dollar. That distinction still shapes the debate over ownership and exit. Treasury's remaining funding commitments have not disappeared. Fannie has about $113.9 billion available under its agreement. Freddie has about $140.2 billion. Those commitments are designed to prevent a net worth deficit from turning into immediate insolvency. They are far smaller than the mortgage books, but their existence tells bond investors the government has a formal mechanism to inject capital. This corrects the headline risk. Taxpayers have not guaranteed a $7.8 trillion cash payout. That number describes the approximate scale of the two mortgage businesses. Actual losses would depend on defaults, home values, recoveries, private credit protection, and enterprise capital. The federal exposure is contingent. It becomes expensive only after losses move through the layers ahead of Treasury. Those layers are much stronger than before the crisis. Borrower equity absorbs the first decline in a home's value. Many high loan-to-value mortgages also carry private mortgage insurance. Fannie and Freddie hold their own capital and loan loss reserves. They also use credit risk transfer transactions to shift selected mortgage losses to private investors. The system now has more shock absorbers between one default and the taxpayer. Credit risk transfer, or CRT, is essentially a contract for sharing mortgage losses. Fannie or Freddie keeps guaranteeing the mortgage security, but private investors agree to absorb specified losses if the underlying loans deteriorate. The Federal Housing Finance Agency began building these programs after 2012. They became a core part of the single-family guarantee business. Public support remains, but some credit risk is deliberately sold back to markets. The companies are also retaining earnings. Fannie ended 2025 with $109 billion of net worth. Freddie ended the year with $70.4 billion. Yet Freddie reported a $106 billion shortfall to its regulatory capital requirement excluding buffers. The point is not that the companies are insolvent. It is that full independence requires substantially more loss-absorbing capital than current net worth alone. Fannie and Freddie earn heavily from the guarantee layer itself. They collect fees for standing between mortgage borrowers and bond investors. Fannie said guarantee fee revenue produced most of its net revenues in early 2026. Freddie reported an average guarantee fee rate of 56 basis points on new total guarantee exposures in 2025. Scale turns fractions of a percentage point into a major revenue stream. Here, the accounting becomes political as well as financial. The Congressional Budget Office treats Fannie and Freddie as effectively governmental while conservatorship continues. For guarantees expected in 2026, CBO estimates a $4.2 billion lifetime cost on a fair value basis. That method includes market risk. Using standard federal credit accounting, the same guarantees are estimated to save $13.3 billion. Same program, different treatment of risk. Removing government support sounds cleaner until the mortgage rate is considered. CBO says expectations of federal support increase mortgage availability and reduce borrowing costs. A Federal Reserve study of the pre-crisis market estimated GSE eligibility lowered rates by about 10 basis points. That historical estimate is not a promise for today, but it shows the trade-off. More private risk can improve discipline while making mortgage credit somewhat more expensive. That trade-off now matters because conservatorship was never designed as a permanent endpoint. Treasury and the housing regulator amended their agreements. in January 2025. The change restored Treasury's consent right over a future release from conservatorship. Any exit must answer several questions simultaneously. How much capital is enough? What federal guarantee remains? And how do policymakers avoid raising mortgage rates during the transition? For a household, these institutional choices arrive as ordinary numbers. The interest rate determines the monthly payment. Guarantee fees affect mortgage pricing. Conforming rules affect which market can fund the loan. Investor confidence affects the yield demanded on mortgage bonds. A family never needs to buy an MBS to depend on the MBS market. The dependency is embedded in the mortgage offer they receive. So who bears the risk when the system fails? First, the borrower loses home equity and may face foreclosure. Then mortgage insurance, credit risk transfer investors, and enterprise capital absorb defined losses. If losses become severe enough, Treasury's remaining commitments can provide new capital. Beyond that point, Congress would face a political choice about additional support. The system spreads risk widely, but it does not make systemic risk disappear. Defenders can point to a deep national mortgage market, long-term fixed-rate loans, and crisis liquidity. Critics can point to concentrated institutions and an enduring federal safety net. Both arguments describe the same architecture. The more credible the backstop, the cheaper and more liquid the securities can become. The stronger the private loss requirement, the less taxpayers should absorb. But private protection has a price. Someone must pay for resilience. Return to the mortgage note. The homeowner sees one contract and one monthly payment. Behind it sits a lender, a security, a guarantee, private risk capital, and Treasury support. That chain helps keep mortgage money flowing when markets are calm. It is also the chain policymakers must defend when markets break. The $7.8 trillion figure is scale, not a taxpayer invoice. The real backstop is credibility layered with capital. The unresolved question is how much public risk is worth cheaper, more stable mortgage credit. Follow the money, find the power.